Assalamualaikum warahmatullahi wabarakatuh. So today I'm going to present about the case study. This is our group member, Danish Izikri, F1057 and Hafiz Saifuddin, F1042. This is for table of content. Question. This is question.
Assalamualaikum and good morning to Sir Hashamuddin. So, my name is Danish Sikri bin Zulkifli. My matrix number is 01DAT23F1057. So, I want to look this question. So, this is this question for our case study, and then this is additional information. So, the additional information, capital allowance, computers, office equipment and motor vehicles. So we need to calculate, and then we have two questions. Is the A, perform the tax computation for Zentel Solution Berhad for year of assessment 2024, and then the second question is discuss five tax planning strategies to help Zentel reduce its tax liability. So we need to calculate, and then we need to present the answer these questions. So I want to start our presentation. So this is the introduction. So this report is prepared for Zentel Solution Berhad, the company, a technology firm that specialize in software development and cloud-based service. The company operates with a paid-up capital of 2.6 million and address to a fiscal year ending on 21 December annually. And then objective of the adjustment, the analysis within this report is structured to address the following two core objectives. The first is part A. We need to calculate tax computation to accurately perform the corporate income tax computation for Zentel Solutions Berhad for the year of assessments 2024, and based on the provided statement of comprehensive income for the year ended in December 21, 2024. And then the second is we need calculate part B tax planning to propose and elaborate on five practical tax planning strategies.
This is answer question. This is answer question A. Computation of tax payable. We have profit before tax 510,000, and we have we add with non-allowable expenses minus double deduction minus non-business income, and we get adjusted income 531,500. And this is the with minus capital allowance 140,000, and we got statutory income 470,500, and we add statutory income from others. We got 470,500, and we minus donation 30,000. We got chargeable income 380,500, and for the payable net, for the tax payable is 24% multiplied by 380,000, 87,500. We got 93,000 for the tax payable. This is note to the account 1. This is extension for note to the account 1. This is also the extension of note to the account 1. This is notes to the account 2, other income, note to the account 3, double deduction, note to the account 4, non-business income, note to the account 5, capital allowance, and note to the account 6, approved donation. Okay, this is for the answer for the question B. Number 1, convert company annual dinner. What the strategy to convert company annual dinner to employee annual dinner? Explanation: if recorded as employee annual dinner 100%, deductible, we get deductible 100% instead of 0%. Tax saving is 60,800. Difference section 39, bracket 1, ITA 1967. For number 2, the strategy is approve donation to Mara Education Fund. The company donated RM 20,000 of the Mara Education Fund, which is approved institution under section 44.6. Such donation are deductible up to 10% of aggregate income. Okay, aggregate income we got 417,500. So it more than 10%, or 10%. So the donation is 30,000. So we choose the lower. Tax saving is 30,000 multiplied by 24%, 7,200. Section 444, bracket 6, ITA 1967. What it means by that? Written off. Jintai wrote off 40,000 in bad debts. These expenses allowable only if previously recorded in income and relates to trade receivable. To minimize deduction, ratio or bad debts written off are trade related and properly documented. So the tax saving is 40,000 multiplied by 24%. We got 9,600. This is under section 33 bracket 1 ITA 1967. For number 4, claim capital allowance instead of depreciation. So the capital allowance we got 64,000 multiplied by 24%, we got 50 15,360. This is under Schedule 3 ITA 1967. Answer for question B. Number 5, apply for international client tax incentive under income tax. For the 2005 profit from export of IT service may get 50% exemption on income from foreign clients. Assume RM 400,000 export profit, 50% multiplied by 24%, we got 48,000 in savings, in tax savings. Thank you very much.
So this is the answer question A. Calculate computation of tax payable. So the first is profit before taxations. 510,000. We need to we need plus non-urban expenses minus double deduction and minus non-business income. We get adjusted income. So non-urban expenses, we have company annual dinner, give to clients, office renovation, managing directors, insurance, approve donation to Mara Education Fund, and then the last is depreciation. So, non-urban expenses, we need a plus, and then we get 397, 500. So, after that, we need to calculate double deduction, and then double deduction we have approved research and development expenditure, and then salary for AKU staff. So the plus, and then we get 216,000, and then the last is non-business income. Non-business income, we need to add and dividends and government grant for research and development expenditure. So we so so non-business income we get 160,000. So profits before tax, the plus non-labor expenses minus double deduction, and then minus business non-business income, we get just income is 531,000 500. So after we get adjusted income, we need to do minus. We need to calculate statutory income, aggregate income, charge aggregate income, and the last is tax payable net. So after get adjusted income, we need to minus capital allowance. So capital allowance we have current year, which is computers, equipment, and vehicles. So and then the broad forward from year assessment to 2023. So we get capital allowance is 100 40,000. So and so adjusted income minus we get statutory income 470,500, and then after that we need plus statutory income for others. So statutory income for others, we all these exempted. So 470,500 is agri income is also. So after that we need to minus donations. With donations, so this is the donation is 30,000. So we get chargeable income 370 387,500, and then after that we need to calculate tax payableness. Tax payableness in the percent is 24%. So 387,500 equals 24%. So we get the last answer. Tax payable net is 93,000. So this is a notes to the account. So based on the answer tax computation, we have the detail the notes. So this is a note. The notes one is urban expenses and non-urban urban expenses. So the first is salaries for the technical staff is all of the expenses, and then software license renewal is eligible expenses, write off bad debt eligible expenses, company annual dinner non-eligible expenses, and then give to clients brand merchandise. So five uh, 15 15% is eligible expenses, and then 50% non-eligible expenses. So this is the reasons. So the next is managing director's insurance is non-urban expenses, approved donation to Mara Education Fund, non-urban expenses, repair to damage office server is allowable expenses, and the last is office renovations is non-urban expenses. So the last is depreciation. So depreciation is non-urban expenses also. So the next is notes to the accounts, the notes to the income, notes to double deductions, notes for non-business income, and note 5 capital allowance, and the last is note 6 approved donation. So I want to present how to calculate capital allowance. So we have three assets: computer, office equipment, and motor vehicles. So assets amounts the principal we need to equals the rate percentage. So computer amount 150,000 equals 20%, and we get carry amount 30,000, and then office equipment 100,000 equals 10%, and we get 10,000. So the last is motor vehicles is 120,000 equals 20%, and then we get current amount is 24,000. So and then we need to plus all assets, and we get capital allowance is 64,000. And then the next is the company has utilized utilized capital allowance amount to 15,000 carrying forward from the year of assessment 2023. So this is the answer. Question B based on the calculation test computation. So the first is convert company annual dinner to employee annual dinner. So this is the if record as employee annual dinner 100% deductible instead of 0%. So this is the calculation. So annual dinner is 17,000. So that 7 is 24%. So we need equals, and then we get 16800. So the second is approved donation to Mara Education Funds. So the company donates 30,000 to the Mara education funds. So the calculation is agri income is 470,500. So deduction is 30,000. So tax saving is we need to equals agri income equals deductible deduction. So we get tax savings is 7,200. So the third is optimize bad debt write off bad write off. So the interest wrote off 40,000 in bad debt. This is expense is allowable only if it was previously recorded as income and related to the trade receivable. So allowable write off is 40,000 and the deduction is 40,000. So tax saving is deduction they equal 24%. So we get 9,600. So the next is claim capital allowance instead of depreciation. So the this recorded depreciations of 200,000 on assets. And then after that, this is calculations. CA entertainment is 64,000 and then deduction is 64,000. And then we need to calculate that 7 is 64,000 equals 24%, and then we get 15360. So the last is apply for additional client tax incentive. So under income tax exemptions order to 2005, profit from exports of IT services may get 50% exemption on income from foreign clients. So this is the calculations. So they assume 400,000 exports and profits is 50%. So we need to equals 24%, and then we get 48,000 savings. So this is the calculation for the question B. So this is the conclusion. So based on the analysis of presentation solution Berhad financial data, the company's corporate tax computation for the year of assessment 2024 result in a chargeable income of 387,500 and final tax payable of 93,000 at a 24% tax rate. So this computation was reached by adjusting the initial profit for non-allowable expenses such as depreciation and managing directors insurance, deducting non-business income such as dividend and government grant, and utilizing key deduction like the double deduction for approved research and development expenditure, HRDC, claimable training expenses, and their salaries for KU staff along with claiming capital allowance. So moving forward, Zentesh can significant minimize its future tax liability by implementing strategic tax planning, such as maximizing the aforementioned double deductions, ensuring proper documentations for bad debt write-off, and proactively exploring potential tax incentive for international business as reference in the income tax. So this is the difference for the case study. So that's all for me. Thank you.